For the country, if you view it on both these measures that we discussed, the net international investment position and the sovereign debt to GDP, which are both important cyclical indicators, the net international investment position is currently at about minus 10% of GDP. So India is a net debtor country, as I said, $1.27 trillion of liabilities, $900 billion of assets. But on several measures, that indebtedness is not risky. See, just like, early in the life of a person, it is okay to take some debt and say build a house, improve your quality. Just like that, for a country which is trying to grow faster, you are going to be dependent on external capital. So as foreign investors bring in equity, your Indian companies go out and seek foreign debt, it helps you grow faster. So having a marginal negative position is actually not a problem. In fact, it is a desired outcome. This is how Indian policy is designed. The quality of the balance sheet is also very healthy in the sense that most of our foreign assets, are actually very liquid. So almost 65% of our foreign assets are held by the Reserve Bank of India. So if the currency comes under pressure, they can quickly be deployed. These are also very liquid assets, so they can very quickly. So in fact, one of the things that Rajiv was also mentioning, that when you're looking at the balance sheet, how liquid is it? I mean, if you need to get some cash very quickly, can you get that? So in 2013, our situation was much worse. So we had, and that is why we had the taper tantrum and the sharp depreciation in the currency. After that, our balance sheet has actually cleaned out. And in fact, the last couple of years, we've actually accumulated a lot of very healthy reserves. On the sovereign debt to GDP, and the situation is slightly less healthy. Our target is to be at 60% of GDP. We are at about 83% of GDP. The way to solve this problem, though, for a country which is relatively young, is to grow out of it. So debt to GDP, as you can imagine, is debt is in the numerator and GDP is in the denominator. If you try to reduce the debt to GDP by reducing a fiscal deficit, basically the government starts to tax a lot more or spends a lot less, GDP growth slows down. So remember that both these things are growing every year, and therefore the best way to do it is to reduce this ratio back to the sub 70 or maybe ideally 60% of GDP, is to grow nominal GDP much faster. And to do that, you need to invest productively, you need to do a lot of reforms. And if you assume 11% kind of nominal GDP growth over the next 10 years, then I think by 2031-32, we should be falling below 70s.
So Neelkanth, you mentioned a number of things which I think helpful to just deep dive on. First is this notion of the quality of the deficit. And if I can loosely translate it and will be helpful to get your perspective, is that if you are borrowing and then you are using that to build something that gives you more income than the interest you pay out, then it is maybe a good borrowing. Whereas you're borrowing to, go get drunk or whatever else, then, it's not great borrowing, right? So helpful to just kind of put this in the context of a nation, and also has India as a country, progressed on this, or like what does our, quality of spends or quality of assets, etc. look like?
So you're absolutely right that if you're getting 100 rupees of tax dollars, how you spend it actually does have an impact on how the debt to GDP moves. So if you just spend it on giving free power to people, it does not have long-lasting impact. It's as bad as drinking it away. If, however, if you spend it on, say, building a road, connecting, say, Delhi and Mumbai with an expressway where the time taken falls from 23 hours to, say, 12 hours, it can improve the economic productivity and therefore the growth of the economy for many, many years to come. So that's how it is. You can keep spending, because if you cut down spending, the GDP growth slows and that ratio starts to worsen. But if you keep spending, but you spend productively, it is possible over a period of time to do this. The reason why this 73-74% became actually 89% a couple of years back was primarily that nearly 50-60% of the income losses during the COVID lockdowns were borne by the government. And so we, as an economy, collectively decided to put it on our future selves or our kids, that, the future taxpayers will bear the loss, because if you had allowed those losses to go through the economy, it would have been much more damaging. So now that this debt to GDP has gone up, we need to bring it down. And I think the prudent way to do that is by spending it on infrastructure, on what you call the high multiplier sectors. It is, where are we now? So at least the choices by the central government have actually been very prudent. So they have, as they had indicated 2-3 years back, they're bringing down the fiscal deficit. The quality of expenditure has gone up, though it would be unwise to believe that this is how things will progress over the next 10 years, because you can always get governments with very different political objectives, and you're seeing that in some of the states where there's a lot of fiscal